there, financial freedom seekers. Let me ask you something. What if everything you've been told about retirement planning is only half the story? Index funds are often called the best passive investment strategy. But are they enough? What if I told you relying only on index funds could leave your retirement vulnerable? Stick around, because today we're uncovering what's missing from your strategy and how to truly secure your future. The reality check. Are index funds the holy grail? Raise your hand if you've heard this before. Just invest in index funds and you're set for retirement. It's great advice. To a point, index funds are cheap, diversified, and have a history of solid returns. But here's the thing, they follow the market. When the market goes up, great, your investments grow. When the market crashes, not so great. Your nest egg takes a hit. And if you're planning to retire during a downturn, you could be in serious trouble. Let me paint a picture. The risk. What if the market crashes right before you retire? Imagine you're retiring in 2025. The market is booming. You're excited to start withdrawing your funds, but then, bam, the market tanks. Not just a dip. Think 2008 all over again. In 2008, the S&P 500 lost 37% in a single year. If you had $500K in an index fund, you'd have lost $185K overnight. That's the risk. Index funds work until they don't. And while history shows markets eventually recover, if you need to withdraw funds during a downturn, you're locking in losses permanently. So, what's the solution? Diversify beyond stocks. Let's explore some alternatives that can complement your index fund investments. Real estate investment trusts, REITs. Invest in real estate without buying property directly. Provide steady dividend income, a hedge against stock volatility. But beware, rising interest rates can impact REIT performance. Bonds, the stability factor. Bonds, especially government bonds, provide stability when stocks fall. Historically, they move opposite to stocks, a balancing force in your portfolio. But in 2022, both stocks and bonds declined due to high inflation, proving they're not foolproof. Commodities, gold, silver, etc., a hedge against inflation. When the dollar weakens, commodities tend to rise. Peer-to-peer lending. Platforms like Lending Club and Prosper let you lend directly to individuals or businesses, not tied to stock market movements, but carries default risk. Many platforms have scaled back due to rising borrower defaults, so research before investing. The bucket strategy, a smarter retirement plan. A simple way to balance risk is the 3-bucket strategy. Bucket 1, cash and short-term bonds, 1 to 2 years of expenses. Keeps you covered in downturns. Bucket 2, dividend stocks and REITs, 3 to 10 years. Provides income without heavy risk. Bucket 3, growth investments, long-term. Stocks, index funds, and high-growth assets. This strategy ensures that even if the market crashes, your short-term needs are covered without selling at a loss. What about fees? Is this market timing? Now, I hear you. But don't these alternatives have higher fees? Yes, some do. But paying slightly higher fees for diversification might be worth it, especially if it means protecting your retirement from market downturns. And no, this isn't market timing. We're not predicting crashes. We're just being prepared for any market condition. Think of it like a seatbelt. You don't wear it because you expect a crash, you wear it just in case. All right, let's bring it all home. Index funds are great, but they shouldn't be your only strategy. True financial security comes from smart diversification. By adding REITs, bonds, commodities, and alternative investments, you build a stronger foundation. So, what do you think? Are you diversifying beyond index funds? Drop a comment below. I'd love to hear your thoughts. If you found this video valuable, smash that like button and share it with someone planning for retirement. And don't forget to subscribe for more financial wisdom. Until next time, plan smart, invest wisely, and secure your future.